Good morning.
Good morning to you.
Good morning. Well, I'm glad you're able to join us today for another episode with Doctors.us Live. My name is Andrea Lee, and alongside with me is Dr. Stephanie Ardrey. We both here to bring you useful financial information in hope to help you grow in your own financial journey.
Yes, how you doing?
I'm doing great. It's a nice day here in Southern California. Sunshine, clear sky. Yeah.
Yes, well, it's transitioned into, as they say, I guess the first day of spring. I thought I heard that this morning on the news. So, spring, here we come.
Indeed. Yeah.
Yeah, it looks to be the same here from Nevada. The sunshine is out. I haven't stepped out to see if that's a warm sunshine or if that's a sunshine with a high wind that's still blowing, blowing blowing past, taking away the warmth of the sun because of the wind factor. But
Right.
hopefully it's
Right.
not. Hopefully it's sunshine and a little warmth. I'll be looking forward to that.
Yeah, we can have a change of weather, right? I mean, it's the spring season, so expect perfect weather. Well, we are entering the in the middle, almost in the tax season. So, what are the tax mitigation strategies for 2024 that individual or business can use, and as a strategy to reduce tax liabilities and increase income. Um, so today, that's what we're going to dive in today, and hopefully, there are tips that can be useful for your business and for your own financial journey.
Oh my goodness, this is such a timely topic. You're right. Here it is, almost the end of March. So you know what that means. Folks will be rushing. Typically, personal taxes are due April. So, and then some business taxes and quarterly taxes and filings. So all of those things are in play. I know my friends who are CPAs, it's like, don't try to call anybody. They're up to their ears typically doing, last minute audits, checks, validating numbers, seeing if there's any strategies left to do to mitigate any excess earnings and reduce potential tax liabilities. And sometimes it's about just shifting those dollars, for example, to other interest. In fact, I was talking to a colleague in the art space, and he was sharing how around this time, in particular, a number of law firms, professional corporations will purchase artwork.
Oh
Uh,
wow!
Believe it or not, artwork, although it's a valued asset, is considered a tax deductible expense. So imagine that you're going to potentially have, $1 million uh, tax liability, and you can reduce it by, a few hundred thousand or so by purchasing a beautiful piece of art. Imagine that.
Right. And from the retirement standpoint, if you have a business that have a liability of $1 million more in tax, there are ways that you can divert some of that tax that go into Uncle Sam into your employees, investment to your employees, defined benefit plan, and for yourself. And it's tax deductible. And that is a way that you can inquire or keep talent loyalty, and at the same time giving a lot of value to your employees and increase future incomes by reducing the taxes.
Oh yeah, it's so awesome that there are literally win-win strategies that you can use, both to make sure that you take care of your people, which I think is really important, and depending upon your organ and your your organizational culture. You want to create that stickiness where people have the desire to be part of and grow with and contribute to your overall, business and growth, right? And those things continue to evolve over time. So finding ways to not only reward, but reward in a meaningful way. So that the employees are able to benefit, because of course you can give a person an increase in terms of their compensation. But usually that just means that either they're kicked into a higher tax bracket, or sometimes they're just paying more in taxes if they don't have some other mitigation strategy in place. So it's like you want to, provide a win, but is it a win or is it a loss, right? So having strategies are important, and this is that time.
Right. And especially if you have a C Corp, there is a strategy of using a split dollar to fund your retirement. And it is tax deductible because it's part of the business expense for your, as a business owner or for your key employees. And also, maximize retirement contributions. Maximum the allowable amount to retirement accounts. We're talking about 401k, IRA, or self-employment retirement plans that help to lower your taxable income. And as far as the 401k, you defer the tax, and that the interest I earn over the years, of course, later on will be taxed when you RMD at age 73, that you have to take out a required minimum distribution from the plan. But, right now as a corporation, you can divert some of that money instead of paying to tax, use it as an expense to fund your retirement accounts for your employees and for yourself. So there are, different limits on how to do that. And if you don't know how, you can reach out to us and we can show you ways to strategize that into your business.
Absolutely. I think that that's one of the benefits, of planning. So a lot of times what happens is if you've put in place some type of forward-looking planning, then you can anticipate where you might be as it relates to your liabilities and what your tax requirements will be. The problem is sometimes people wait to the end and they run out of options.
Right.
So, with that being said, what typically do you know are the cutoff dates? Like, how far into a tax filing period are you able to go and still be able to put some of these programs in place? I know that in times past, I've had a situation where there was going to be a potential tax liability. And I remember my CPA telling me, well, in this particular situation, it made sense to buy another property, but I had to close on the property by a certain time in order for those costs and expenses to be a deduction that I could take in that tax year. Are you familiar with when one might have to activate a policy if they were looking to use a life insurance policy, for example, to offset some of their liability or to redirect some of their revenues?
Well, if you have a C Corp that's setting up a plan for yourself or for your employees, you want to do that far in advance because it does take time for the application process to go through because, you up through that application process, can take weeks or a month or so, or even more, depending on your situation, your financial situations, and also your health situations. So, it's best also check with your CPA. When is your tax due? Can you postpone your tax? And that way we can have the plan in place before you're filing your taxes. That way, it's aligned with your goals. And basically, the far more in advance you plan is the better because you have more time to divert the money and also to plan to see how much you put in and how much tax it can be deducted from your business expenses.
Absolutely. Planning in advance is always key. But what's interesting that I notice is that time is speeding so fast. When I think about, oh my goodness, it seemed like you blink and we were just starting the new year. So to say that we're already beginning spring, the months are moving rapidly. So sometimes you do lose sight of the time and schedule. So I think it's important to put dates, like I put reminder dates on my calendar a month in advance of critical deadlines, and additional reminders just to come up. But one of the things that you brought up that's very important is knowing that you can file for an extension. Obviously, you need to speak with your tax professionals about some of these things that we're discussing, to verify that they are options available to you for your business and they make sense. But certainly, just generically speaking from personal experiences and other business experiences, you can file for an extension if it is that you need additional time to make sure that you've properly prepared your tax plans and you've considered whatever mitigation opportunities are available. And sometimes, you may find yourself in a situation where you've actually filed and completed a return, but discovered that there's a need to amend a return. So sometimes, a return has been prepared, but there was a mistake or there was additional information that you found. And of course, you don't want to use that as an ongoing situation if you can avoid it to have to refile. But on occasion, it does make sense to look either back or look forward, as relates to expenses and losses. So sometimes you may have missed the opportunity to claim something, but you're able to roll it forward or you're able to roll it backward. And in doing so, you're able to find some relief from some of the taxes that maybe were previously incurred or presumed to be assessed. So there's all kinds of ways of understanding, the financial planning process and timing around that process to make it work for your needs.
Right. I mean, if we don't take the time out to really look into a retirement plan or an account that help you to minimize your tax, and sometimes we just push it at the back of the burner, and time goes by and you forget about it. So you're losing all these time. Time is money, right? Compounding interest over the years is powerful. So it's important that you set that up as early as you can. Take advantage of the tax. Advantage accounts such as HSA or flexible spending account or health spending account. These have really like a triple tax advantage compared to 401k, because the money, the contributions are tax deductible, the earning growth is tax free, and the withdrawal for qualified medical expenses are tax free also. So it's a triple advantage account to have, you can set up for yourself. And individuals can contribute up to 4,150 in their HSA accounts into the 2024, and families you can go up to $8,300 per year for that.
Oh, wow. Wow, that's important. And typically, as we have previously shared, it's often a medical emergency or something to that nature that can create financial distress in a family, because you're not certain when something happens, and it happens suddenly, and then you have a critical condition and you find that not only do you need the additional resources to deal with the particular prognosis, but you also need resources to maintain your household, your living, your lifestyle expenses and requirements, while you also face whatever, that health concern may be. So it's great to have additional resources that you can tap into, to provide relief where necessary.
Yeah, the different investment strategies ones can have, or a business or a corporation can have. Review your investment strategies. Opt in for tax efficient investment strategies that help you to reduce your tax. Some people would have municipal bonds or Roth IRA, 401k, and all of that. You need to know where your money going to, your bucket of money. So there are four important bucket of money that you may want to look at. That's where all your money will go go into. First is taxable asset, which is tax now. These are considered stock, bonds, mutual funds, CDs, cash savings in your bank account. So these will have some kind of interest by the end of the year under 1099-U. So that's called tax now bucket. Now you need to know how much you have in this bucket, and also divert some of that into a non-taxable bucket, or a tax defer. Most the strategy that we want to utilize the most is the tax-free bucket. But most people would have their money into the tax deferred bucket, such as 401k, 403b, IRA, or annuity. So these are just tax deferred. You contribute the money into the account, all tax deferred. So down the road, you compound the interest over the years, but when you take out the money, they're all taxable. And majority of Americans have their money in this bucket. And over the course of 20, 30 years, when you work and save up money, I know a lot of people put lots of their money into the 401k because they don't have any other plan, or they don't know any other plan existed out there that help to grow their money. So back then in the day, before I started all of these, I didn't know. I put maximum contribution into my 401k because I thought that was the best plan that I could do for myself, at least save the money, right? So I max out every single year, and the account can grow a lot. But then I didn't know about the tax liability, not being naive. And I thought a lot of people, the misconception is people think once you put your money in the 401k, down the road, when you take it out, you don't have to pay tax. But in reality, you owe tax. IRS is your partner along the journey of 401k. So they determine the tax bracket that you're going to have to pay later on. We don't know what the tax bracket going to be, 10, 20 years later, right? The market fluctuate. That ceiling is going up. How do American or the government can recoup the tax, right? Is it making sense to increase tax? That's a possibility. We don't know.
Always.
Right? But if the tax are going up and the IRS is your partner in this account, they tell you how much tax they're going to tax you later on. So, think of a way to divert some of that money into a bucket that help you to save tax or tax-free retirement later on. Another bucket I want to talk about is tax exempt municipal bonds. It's not tax-free, but just tax exempt. So these are the municipal bonds that issued by a local government or state that help to finance certain projects like school, roads, or utilities. And the income you earn from this is tax exempt from federal income tax, and so in some cases from state and local income taxes as well. It's very small amount go into this one. Only usually business owners or high wealthy individuals that want something low to get the tax exempt. They divert some of their money into this one. But the last bucket that we want to talk about is a tax-free bucket, which is Roth IRA and life insurance.
Yes.
And not lots of people know about Roth IRA, but there's quite young individuals don't even know what the Roth IRAs is. I just talked to a gentleman last week, and he said, I just found out about Roth IRA like a year ago. And, he seemed pretty well educated too. But, we don't know what we don't know, right?
Sure.
So Roth IRA is a great vehicle for you to contribute the money because it's after tax dollar, and whatever you earn is tax-free later on when you withdraw the money. However, there's a limit of how much you can contribute. If you're making over a certain amount of income, you're not allowed to contribute into the Roth IRA account. So there are strategies that utilize like life insurance, that there's no limit of how much you can put in. and the money can grow tax deferred and access tax free later on, and you have so much more benefits in the life insurance, but it needs to be set up the right way, that match with your goals and your objectives. So life insurance, we're not talking about just life insurance here. Life insurance nowadays have a lot of benefits, living benefits, and in case of critical illness, chronic illness, or critical injuries, you can access some of that debt benefit in advance while you're still living. So now if you put that money in a 401k or a Roth or IRA, that debt benefit is not there, right? Whatever amount that you put in, let's say you have 10,000, just 10,000, but in life insurance, you can leverage that 10,000 and get 100,000 of coverage, or $1 million coverage, or 500,000, even more so, depending on your budget, that allow you to leverage that, and have a better protection for yourself and for your family as well. Especially death benefit is tax free when you access that, or or God forbid we pass away, that money go into our family tax free, and the income, the amount of money in there accumulate compounding interest over the years, and you can access that money as a supplemental income tax free. So there are
Absolutely.
so much benefits in life insurance, that we can utilize. And you don't know how to set up these plans, reach out to us. We can walk you through the process. And it's all free consultation. So reach out and we can show you how to set up the right way to maximize your earning and your potential.
Absolutely. No, I was speaking to someone in fact, and sometimes, people begin to hear some of these terms and terminology, and so they think about, okay, yes, then let me work on this. And it's important to realize that it's like a buffet of options. And
Right.
so it's fantastic that you know about one thing, but you want to make sure that you understand that there are a buffet of options, and many things may make up your overall complete puzzle and strategy. So don't be afraid to inquire about different layered strategies. This person in particular was mentioning that they were now getting, set to work on a trust, and I'm like, great, that trust is fantastic, but in the focus of wanting to assist their grandchildren, I said, one of the things that you could do that's even better for your grandchildren, or in addition to what you're planning for your grandchildren, is to set up whole life policies for each of them, especially while they're young
Right.
and while they have, probably the best health profiles that they'll have, because then the cost of the insurance typically is lower. And so you could do things like for birthday gifts, for holiday gifts, and things of that nature, make contributions to those various policies. And you could even share with other family members that same idea, that instead of buying things that are basically not adding any value. And I'm not saying that you deprive the kids from having gifts and toys and all of those things, yes, but we could split. We could spend this much on those things and sock away this much. Trust me, you'll appreciate the sock away resources much later, when they've benefited from some compounding interest and all of those things. So if your grandchild, for example, is a minor, 1, 2 years old, I told them, as soon as your baby is issued a social security card, and you have that birth certificate, then that's the time to start exploring setting up a whole life policy for the benefit of each of those children.
Yes, starting early is very important, especially if you are a business owner. You can hire your kid. Not only people aware of hiring your kid. If you don't know how, just Google this. This is so much. It's very important, and it's tax deductible for your business. So for 2024, you can hire your kid for, I think the limit is 13,800, and it's tax deductible for your business, and use that to fund a plan, a retirement plan, a college planning plan for your kid starting at early age. And that helps to compound the money over the years. And by the time they get older, during the college year, you can withdraw that money to pay for college, or down the road to pay for a car or a wedding or buying a house even. So there is so much that you can do within that plan. And of course, setting up earlier is better because that would give them years of compounding the interest and leverage that to grow the money. And it's totally tax deductible for your business. So know how to do it. Google it if you want to find out, and talk to your CPA so they can help you with the process of setting that up properly to make sure you're complying with the IRS rule.
Absolutely. And, but it's so interesting. And Tiffany, you mentioned that someone had sent me a link to a little boy that was learning how to tile a house. And, the comment was around, teach your children early how to have trades and to contribute so that they can have ways to take care of themselves. And I was just like thumbing up. Yes, yes, this is what I'm talking about, because the truth of the matter is that you should be the first place that your children began to gain some understanding of how they can be empowered to take care of themselves. What are the skills that they have that can be further developed? What are their interests? And, I used to tell my son when he was a little tyke, it's all a business. So the more you understand that whatever it is that you have an interest in really is a business, there's somebody in that business or that is part of someone's business, thinking of those things from that context, that perspective would empower you to know that you always have an opportunity to create a way for your existence, your survival. And if you take smart and make smart decisions along the way, because a lot of times people will say, well, I don't have sufficient capital, or I don't make enough, or I don't this. And it's like, no, absolutely. It's not necessarily true. It's that your spending decisions, the things that you choose to allocate your resources for, are not necessarily all of the best decisions. So you're not really allowing your resources to compound or grow and expand. You're just exchanging time for dollars. And that can be exhausting, and that can feel unfulfilling if all you're doing each day is exchanging time for dollars, and you're never allowing those dollars to have an opportunity to grow and go to work for you, so that at some point you won't have to just exchange time for dollars, but you actually have resources that have begun to accumulate in other forms.
I know, we're so busy working every day, and we just work, and save up to pay or pay for expenses every day. But we don't think of a strategy to put those hard-earned money into hard work. I mean, right? Are working hard to earn you more money. So not only you working hard for your money, but make sure your money is working hard for you as well. And as a business owner, if you have a business, use business expenses deductions. You may have equipment purchases, business travel expenses, home office expenses, hire your kid expenses. You can set up a retirement defined benefit plan for your business, and that is tax deductible. And how to do so, I mean, we can walk you through that whole process, how to set up properly so that you can get all the tax advantage. But there are so many ways that you have a business, you can utilize those, strategies available for you, and not a lot of people are aware. And, putting more hard-earned dollar back into your pocket, right?
Absolutely. Whatever you can do to get those dollars back and help them to do something extra for you, right? Instead of just
Right.
going in and out, right? Yeah.
Right.
It's amazing, Andrea, we have these conversations each week, and every time we touch on a topic, there's so much information that we want to share. And then I look up and it's like we begin and we're already at the top of the at, the half hour. We're already at that conclusion point. What are some last points that we can leave our guest with before we conclude our conversation today?
There are so many financial strategies that traditionally, we only know a few and we think those are the best, but they are not. There are plans out there that the rich are utilizing ways to earn more money, compounding more monies. So the strategy that can be tailored to your individual's financial situation and goals, and consult with your financial advisors or tax professional that help you develop a more comprehensive plan or retirement tax mitigation strategy that align with your specific needs. So it's important that speak to someone that help you. If you don't know, ask question. And sometimes, a lot of time we don't know what question to ask, right? We just don't know what we don't know. So, reach out to us. We'll tell you what we know. And
Absolutely.
to see if that's aligned with what you need. And we can help you set up the right way to align with your goals. Wow, we are running out of time. Thank you so much for tuning in. And as well, always, you can catch us every Wednesday at 10 a.m. Pacific time. We invite you to join us weekly and, prioritize your well-being and your family. If you have a plan in place, review it, update it to make sure it is the best for you. And if not, reach out to us.
Absolutely. Reach out to us and we can provide you with some support. And I guess for that, we're going to say thank you again. And guess what? We'll see you next week. So come
Thank
back
you.
Wednesday. If it's 10 a.m. on Wednesday, it's Wealth Doctors. We hope to see you again. Have a great week, guys.
Thank you.